Welcome to the Investing for Beginners Masterclass powered by NexAura-FinanceHub, your go-to platform for financial literacy and wealth building. Whether you're just starting out or you've been curious about how normal people turn small savings into real wealth, you've come to the right place. At NexAura, we believe financial education is the ultimate superpower. Our mission is simple. Equip you with the knowledge, strategies, and mindset to take control of your money and build a future that works for you. In this masterclass, we'll break down investing in a way that's easy to understand and practical to apply. You'll learn how to manage cash flow, make your money work for you, understand risks without fear, and take consistent steps toward long-term wealth. We'll explore real-life examples, relatable scenarios, and actionable strategies. No jargon, no fluff, just clear step-by-step guidance that empowers you to start building wealth today. So if you've ever wondered why investing seems like it's only for the rich, get ready to discover the truth. It's not about having money first. It's about learning how to grow it wisely. Most people believe investing is something only the wealthy do, something reserved for billionaires, boardrooms, and people in suits on Wall Street. But here's the truth. Investing isn't what you do after you get rich. It's how ordinary people become rich. Think about it. If you rely only on a paycheck, you're limited by time. You trade hours for money, but money itself can work harder than you ever could. When you invest, every dollar becomes an employee, working for you 24 hours a day, 7 days a week, no breaks, no sleep. And here's the best part. The people who build wealth don't always start with millions. Many start small, $50 a month, $100 a month, but they start. In this masterclass, we're going deep. You'll learn how everyday people own tiny slices of companies like Apple, Nike, or Starbucks without ever working there. You'll discover how real estate can either build passive income or quietly drain your wallet. You'll finally understand compounding, not as a math term, but as the engine behind wealth. And along the way, you'll hear stories. Ordinary people who grew extraordinary wealth. By the end, you'll see investing differently, not as something far away, not as something for other people, but as something for you. So let's begin. Let's start with a simple question. Why invest at all? For most people, money only comes from one source, their job. You put in hours, you get paid. But here's the problem. Your time is limited. You can't work 24 hours a day, but money can. When you invest, you're making your money work for you. Think of every dollar as a tiny employee. Some people send their dollars to buy a coffee or a new gadget. Others send their dollars into businesses like Apple, Nike, or Starbucks. Those dollars now come back with friends in the form of profits, dividends, and growth. Here's a simple example. If you had invested $100 into Starbucks 20 years ago, today it would be worth over $2,000. Why? Because as Starbucks grew, the value of your little slice grew with it. That's the essence of investing. You don't have to build the business yourself. You just own a piece of it and share in the rewards as it succeeds. And the earlier you start, the more powerful this becomes, because time and growth work together like fuel and fire. In the next chapter, we'll break down how to actually invest, step by step. No confusing jargon, just practical, simple ways to get started, whether you have $50 or $5,000. Now that we know why investing matters, the next question is obvious. How do you actually get started? Step 1 is simple. Open an investment account. This is like the doorway into the world of investing. Without it, you can't buy or own anything. Think of it like opening a bank account, but instead of holding cash, it holds investments. You can open one through apps like Robinhood, Fidelity, Vanguard, or even your regular bank. Step 2, decide what you actually want to buy. For beginners, it helps to start with something you understand. Imagine buying one single share of Nike. You don't need to start big. You can buy with as little as $20 or $30. Step 3, think about diversification. Instead of putting all your money into one company, you can spread it across many. That way, if one company struggles, others balance it out. Here's a simple way to picture it. If you only owned Blockbuster in the early 2000s, you lost everything when streaming took over. But if you owned a mix, say Blockbuster, Apple, and Netflix, then Netflix and Apple would have carried you forward. Step 4, start small and be consistent. Most people think they need thousands of dollars to invest. Not true. Even investing $50 a month can grow into tens of thousands over time. And here's the final step. Automate it. Set up your account to automatically invest a small amount every month. This removes emotions and makes wealth building a habit, not a struggle. So, to recap, open an account, choose what to invest in, diversify, start small, automate. These 5 steps are your foundation. Next, in Chapter 3, we'll unlock the secret that makes investing so powerful, compounding. And I promise, once you see how it works, you'll never look at money the same way again. Albert Einstein once called compounding the 8th wonder of the world. He said, "Those who understand it, earn it. Those who don't, pay it." So, what is compounding? It's when your money not only earns returns, but those returns start earning returns too. Think of it like planting a tree. At first, it's just a tiny seed, but as it grows, it drops more seeds. Each of those seeds becomes another tree, which then drops even more seeds. Before long, you don't just have one tree, you've got a forest. Here's a money example. Imagine you invest $1,000 and it grows 10% in a year. Now you have $1,100. The next year, you don't just earn on your original 1,000, you earn on the 1,100. So your returns are a little bigger. And every year after that, the snowball grows larger and faster. Let me give you 2 different stories. Sarah starts investing at age 25, putting in just $200 a month for 10 years, then stops. By the time she's 65, she has over $500,000. Now compare that to Mark. He waits until 35 to start. He invests $200 a month all the way until 65. He puts in way more money than Sarah, but because he started later, he ends up with less. That's the magic of time and compounding. It's not about timing the market. It's about time in the market. The earlier you start, the more powerful compounding becomes. Now, some people hear this and say, "But I only have a little money. Does it even matter?" The answer is yes. Even small amounts can snowball into something huge. Imagine putting aside just $5 a day, the cost of a coffee. If you invest that consistently with compounding, it can grow into hundreds of thousands over your lifetime. One small habit, creating massive results. So here's the big takeaway. Compounding rewards the patient, the consistent, and the disciplined. It's not a get-rich-quick trick. It's a get-rich-sure method. For many people, real estate feels like the ultimate investment. Buy a house, watch the value rise, retire rich. Simple, right? Well, not exactly. Real estate can absolutely build wealth or become a financial trap if you don't understand the difference between an asset and a liability. Here's the key rule. An asset puts money into your pocket. A liability takes money out. So let's test this with an example. If you buy a house and every month you pay the mortgage, the taxes, the insurance, the maintenance, and nothing comes back in return, that house is a liability. Yes, it may appreciate over time, but month after month it's draining your cash flow. Now flip the story. You buy a small duplex. You live in one unit and rent out the other. That rent covers most of your mortgage. Suddenly, the property is helping to pay for itself. Now it's an asset. Here's another real-life scenario. Imagine Harry, who bought a second home by the beach. It cost him $2,000 a month in mortgage and upkeep. At first, he thought it was an investment, but since he rarely rented it out, it became a constant money drain. That wasn't an asset. That was a lifestyle expense. Meanwhile, Maggie bought a small single-family home in her city. She rented it to a family for $1,500 a month, while her mortgage was only $1,000. That $500 difference? Pure positive cash flow. Month after month, Sarah's tenant was helping her build wealth. This is why real estate can be tricky. It's not automatically an investment just because you own property. The real question is, does it pay you or do you pay it? One more thing to remember. Real estate is not passive in the beginning. You might need to handle tenants, repairs, taxes, and unexpected costs. But over time, if managed well, it can become one of the most powerful wealth-building assets you'll ever own. So here's the big lesson. Your home is not automatically an investment, but if you learn how to make real estate pay you through rent, cash flow, or appreciation, it becomes a real wealth-building tool. Let's talk about myths, because for many beginners, it's not money that holds them back from investing. It's the stories they believe about money. Myth number 1. Investing is gambling. I get it. The stock market looks like numbers flashing up and down, people shouting on trading floors and stories of fortunes made or lost overnight. But here's the truth. Gambling is based on luck. Investing is based on ownership. When you invest, you're not rolling dice. You're buying pieces of real businesses. Businesses that sell products, pay employees, and generate profits. That's very different from pulling a slot machine handle. Here's a story. Imagine if your favorite coffee shop offered you the chance to buy a tiny slice of ownership. Every time someone bought a latte, part of that money would be yours. That's what investing in a company is like. It's not gambling. It's becoming a co-owner. Myth 2 is you need a lot of money to start. This one keeps more people stuck than anything else. They think unless they have thousands of dollars sitting around, investing isn't for them. But the reality? Today, you can start with as little as $5 or $10. Apps and platforms let you buy fractional shares, tiny slices of a stock or fund, so even a small amount gets you in the game. Let's take an example. Imagine Laura, who invests just $50 a month starting at age 25. By 65, with compounding, she could have hundreds of thousands saved. Now compare that to someone who waits until they have enough to start. They often lose years, and years are the most valuable currency in investing. Myth number 3, the stock market is only for the rich. Let me be clear. The stock market is not a private club for millionaires. It's a marketplace, like a farmer's market. But instead of apples and oranges, what's for sale is ownership in businesses, and anyone can buy in. Here's a little-known fact. Most of the wealth built in the market didn't come from day trading billionaires. It came from regular people, teachers, nurses, small business owners, who invested a little at a time, month after month, for decades. Slow, steady, consistent growth, not get-rich-quick schemes. Now, there are plenty more myths we could cover, like, you have to be a financial expert, or you'll lose everything in a crash. But here's the truth. While investing does carry risks, most of the fear comes from misunderstanding, not reality. And that's why financial literacy matters. Because once you see through the myths, you can make smart, calm, confident choices with your money. In the next chapter, we're going to tackle something just as powerful as money itself, the psychology of investing. Because growing wealth isn't just about dollars, it's about mastering your own mind. Here's a secret most financial experts won't tell you. The hardest part of investing isn't math. It's emotions. Think about it. When the market drops, your brain screams, "Sell! Get out now!" When the market rises, the same brain whispers, "Buy more! Don't miss out!" That tug of war between fear and greed is what makes investing so challenging. Let's walk through a scenario. It's 2008. The global financial crisis hits. Stocks are crashing. News headlines are screaming words like collapse and meltdown. Imagine you had $10,000 invested in the market. In a few months, it drops to $6,000. Most people panicked. They sold at a loss. But those who stayed patient, who held on or even bought more, saw their investments recover and eventually grow far beyond their original value. Patience, not panic, won the day. Now, let's flip the story. It's 2020. A new wave of technology stocks is booming. Everyone online is bragging about quick gains. People start pouring in, not because they studied the businesses, but because they feared missing out. That emotion, called FOMO or fear of missing out, led many to buy at the top and lose money when prices corrected. This is why mastering your emotions is as important as mastering financial knowledge. Because money decisions are never just numbers on a screen. They're tied to fear, hope, pride, and even identity. Here's a practical tip. Before making any financial decision, ask yourself, am I acting out of fear or out of logic? If the answer is fear or greed, pause. Take a breath, step back. Another strategy is automatic investing. By setting up a system where money is invested on the same day every month, no matter what, you remove emotions from the process. You don't have to time the market. You just stay consistent. Remember, your emotions can be your greatest enemy in investing. But with awareness, discipline, and patience, they can also become your greatest strength. In our next video, we'll dig into something every beginner needs to hear: risk management. Because it's not just about how much you make, it's also about how much you protect. Let's be honest, most beginners get excited about investing because of the upside. The thought of doubling money, of becoming financially free, of making life-changing wealth. But here's a truth every successful investor knows. It's not how much you make that matters most. It's how much you keep. That's what risk management is all about, protecting yourself so you can stay in the game long enough to win. The first principle of risk management is simple. Don't put all your eggs in one basket. Here's an example. Back in the early 2000s, a company called Enron was seen as unstoppable. Employees believed in it so much that many invested their entire retirement accounts in the company's stock. But when Enron collapsed in scandal, thousands of workers lost not just their jobs, but also their life savings. Why? Because all their eggs were in one basket. Diversification means spreading your money across different companies, different industries, even different asset classes, like stocks, bonds, and real estate. If one fails, the others protect you. The second principle is building an emergency fund. Think of it as your personal safety net. 3 to 6 months of expenses set aside in cash or a savings account, ready for when life throws you a curveball. Here's why this matters. Imagine John, who invests every dollar into the market but keeps no cash cushion. Then suddenly his car breaks down, or worse, he loses his job. Without an emergency fund, John is forced to sell investments, maybe at a loss, just to cover bills. That's not smart investing. That's being unprepared. The third principle: avoid putting money you can't afford to lose into high-risk bets. During the 2021 crypto boom, many people put their rent money or even borrowed money into coins they didn't understand. When the market crashed, fortunes vanished overnight. Some lost homes, some fell into debt, all because they confused speculation with smart investing. Here's a rule of thumb. If losing the money would keep you up at night, don't put it in a risky investment. Another overlooked part of risk management is insurance. It's not exciting. It doesn't make you rich, but it protects the wealth you're building. Health insurance, car insurance, even life insurance, they all exist to keep one accident from wiping out years of financial progress. Finally, remember that risk isn't just about losing money, it's about losing time. If you panic sell every time the market dips, you may avoid short-term pain but guarantee long-term loss. Here's a real example. Between 2000 and 2019, the S&P 500, the U.S. stock market index, delivered an average annual return of about 6%. But investors who missed just the 10 best days in the market during that period cut their returns almost in half. Why? Because they tried to time the market, jumping in and out based on fear. Risk management means staying the course, not chasing perfection. So, to recap, manage risk by diversifying, building an emergency fund, avoiding reckless bets, using insurance wisely, and keeping a long-term perspective. Do these things, and you protect not just your money, but your peace of mind. Up next, in next chapter, we'll talk about a powerful but underrated tool for wealth building: consistency. Because it's not the big wins that usually make people wealthy. It's the small, steady steps taken over years. If there's one secret that separates wealthy people from everyone else, it's this: consistency beats intensity. It's not about investing a huge lump sum once and hoping it grows. It's about showing up again and again with steady contributions over years. even decades. Last time, here's a practical example. Imagine Dami invests $300 every month into a simple market fund. Some months the market is high, some months it's low, but Dami doesn't try to time it. She just invests consistently, month after month, year after year. Loss trace. This method is called dollar cost averaging. It takes the guesswork and emotion out of investing. Instead of trying to buy at the perfect moment, which nobody can predict, Dami buys at all moments. Over time, she ends up with more shares when prices are low and fewer when prices are high. That consistency becomes her superpower. Right now, these steers, when you know, found them in the leaderships out. What's clearly in this series like. Both combine consistency with compounding, and the results are extraordinary. Let's say Dami invests that same $300 a month for 30 years. At a modest average return of 7% a year, she won't just have saved a little over $100,000. She'll have grown it into more than $360,000. That's more than 3 times what she put in, simply because she was consistent. Priv. Dami will saw as the idea. Think of it like fitness. Going to the gym once for 5 hours won't change your life, but going 30 minutes a day, 3 times a week for years, that transforms your body. Wealth works the same way. Dami cannot too regulated between number of opinion opponents packs. When's both is her bascapes between arguments to 14 Amy Pumments, today clearly enjoy that claps. But let's flip the coin for a moment. Consistency works both ways, for good or bad. You current practicing estates of the rising shares to a way, and that's what we talked to it will first important. If you consistently spend a little more than you earn, if you consistently swipe a credit card without paying it off, the small debt piles up into big debt. That's financial quicksand. Building creates the project to bring your phone, spend out of the group. Which means the habits you repeat daily are the true engine of your financial future. Buffett's called point scroteer. Last time when you reducing programs. Please, take Warren Buffett. People call him a genius, but his real magic wasn't picking perfect stocks. It was consistency over time. He started investing at age 11, kept going through ups and downs, and never stopped. Today, most of his billions were made after his 60th birthday. That's the power of sticking with it. So here's the lesson. You don't need to be perfect. You don't need to be brilliant. You just need to be consistent. Set a monthly amount, no matter how small, even $50, and commit to it. Because wealth isn't built in leaps, it's built in layers. In chapter, we'll zoom out and talk about something bigger than any single investment, building an actual financial plan. Because knowledge without a roadmap is like having tools without knowing what to build. To this point, we've talked about investing basics, risk management, and the power of consistency. But here's the truth. Without a plan, all of it can fall apart. A financial plan is like a GPS for your money. It shows you where you are, where you want to go, and the turns you need to take to get there. Without it, you risk driving in circles, working hard, but never reaching financial freedom. The first step in any plan is to define your goals. Not vague goals like I want to be rich, but specific time-bound goals. For example, I want to save $20,000 for a home down payment in 5 years. Or, I want to build a retirement portfolio worth $1 million by age 65. The second step is to know where you stand right now. That means looking at your income, your expenses, your debts, your savings. Think of it like a doctor's checkup. You can't prescribe the right medicine if you don't know the patient's condition. The third step is budgeting, creating a plan for your cash flow. And here's where most people go wrong. They think budgeting means cutting out every coffee, every dinner out, every joy in life. But that's not budgeting. That's punishment. A good budget is about awareness and alignment, knowing where your money goes and making sure it matches your goals. If your goal is a home in 5 years, maybe you cut back on things you care less about, like unused subscriptions, and redirect that money to savings. That's not deprivation. That's strategy. The fourth step is protecting the plan with an emergency fund. Remember, your plan is only as strong as its weakest link. One unexpected medical bill or job loss can derail everything. The fifth step is handling debt wisely. If you're carrying high-interest credit card debt, paying that off is often a higher return than any investment you can make, because every dollar not paid in interest is a dollar saved. Step 6, create your investment strategy. Now here's the key. Your plan doesn't need to be complicated. It just needs to match your risk tolerance, your time horizon, and your goals. For example, if you're saving for retirement in 30 years, you might choose a simple strategy. Steady monthly investments into broad stock funds, with some bonds for balance. If your goal is a house in 3 years, you don't gamble that money in the stock market. You keep it safe in a high-yield savings account or short-term bonds. And finally, review and adjust regularly. A financial plan isn't carved in stone. Life changes. Goals change. The economy changes. Checking in once or twice a year helps you stay on track. Here's a real-world example. Maria, a teacher, created a simple plan. Save 3 months' expenses, pay down her credit cards, and invest $200 a month in retirement funds. She didn't make a huge salary, but because she had a plan, every decision had direction. 10 years later, she was debt-free, had a safety cushion, and her retirement fund had quietly grown into 6 figures. All because she wasn't just working hard, she was working with a roadmap. So, to recap, your financial plan should cover your goals, your current reality, your budget, your safety net, your debt strategy, and your investment approach. Do that, and you won't just drift. You'll drive toward financial freedom with intention. In the next chapter, we'll tackle one of the hardest parts of money, emotions. Because no matter how smart your plan is, fear and greed can sabotage it if you're not prepared. There's a quiet force that can either help you build wealth faster or quietly eat away at your returns. That force is taxes. Now, for many people, the word taxes makes their eyes glaze over. But here's the truth. If you ignore taxes, you could work hard, invest wisely, and still fall short. If you understand them, you can keep more of what you earn, legally and smartly. Let's take an example. Imagine you invest in a stock and sell it 1 year later for a 20% profit. Sounds great, right? But if that profit is taxed at 25%, a quarter of your gains vanish before you even touch them. Suddenly, your 20% return feels a lot smaller. This is why investors pay attention to something called capital gains. Simply put, it's the profit you make when you sell an investment. If you sell quickly, it's often taxed at a higher rate. If you hold for longer, many systems reward you with lower taxes. The lesson? Patience doesn't just grow wealth. It can save you money on taxes too. Another tool is tax-advantaged accounts. Depending on where you live, these might have different names: retirement accounts, education savings accounts, or special investment shelters. The idea is the same. Governments encourage you to save for the future by reducing or delaying taxes on those investments. For example, in the United States, there are accounts like the 401k or the Roth IRA. In other countries, there are ISAs, superannuation funds, or provident funds. The principle is universal. Using the right account can mean thousands, even hundreds of thousands more by retirement. Here's a scenario. Two friends, John and Sarah, each invest $200 a month for 30 years. John invests in a regular account and pays taxes on the growth each year. Sarah invests in a tax-advantaged account where growth compounds tax-free. By retirement, even though they invested the same amount, Sarah ends up with tens of thousands more than John, just because of the tax advantage. That's the hidden power of planning with taxes in mind. And let's not forget dividends, the cash payouts some investments give you. In many places, dividends are taxed differently than capital gains. Sometimes more, sometimes less. If you know the rules, you can structure your investments to keep more in your pocket. Now, I'm not saying you need to become a tax lawyer, but I am saying this: if you don't understand taxes, you're playing the wealth game with one hand tied behind your back. The good news? Most strategies are simple. Hold investments longer when you can. Use tax-advantaged accounts. And always think about the after-tax return, not just the before-tax number. In fact, many wealthy people aren't just experts at making money, they're experts at keeping it by minimizing taxes legally. It's not about dodging responsibilities. It's about being smart and strategic. So remember this: building wealth isn't just about earning more or investing smarter. It's also about keeping what you earn. In the next chapter, we'll explore another essential step: protecting your wealth. Because once you've built it, you'll want to make sure it doesn't disappear overnight. Let's deepen our look at taxes and investing, because this isn't just a side topic. It's one of the most overlooked wealth builders in the world. And remember, every dollar you don't lose to unnecessary taxes is a dollar that can keep compounding for you. Here's a practical global example. In the United States, you might use a Roth IRA to grow your money tax-free. Meanwhile, in the United Kingdom, someone might use an ISA, an individual savings account, with the same benefit, tax-free growth. Two different countries, two different names, but the principle is the same. Without those accounts, every year the government would take a cut of your gains. With them, the growth stays yours. Now imagine two investors in the same country. Both earn a 10% return on their investments. One invests through a taxable account, and after paying 25% in taxes, their return drops to just 7.5%. The other invests through a tax-advantaged account and keeps the full 10%. It doesn't sound like much, just a couple of percentage points, but over 30 years, the difference is staggering. The first investor ends up with around $300,000. The second with nearly $400,000. That's a $100,000 gap, just from understanding how taxes work. Here's another scenario. Lisa buys shares in a company and sells them 6 months later for a profit. Because she sold in less than a year, her profits are taxed as regular income at her full income tax rate. But if Lisa had waited a few more months and sold after a year, her profits would be taxed at a much lower long-term capital gains rate. Same stock, same profit, just different timing. One choice makes her pay hundreds more in taxes than the other. This is why patience isn't just an investing virtue, it's a tax advantage. And let's talk about dividends for a moment. Imagine Mark buys shares in a company that pays a 6% dividend. He's thrilled, free cash flow every year. But then tax season arrives. He discovers those dividends are taxed at 20% in his country. Suddenly, his 6% income is really just 4.8%. If Mark had invested through a retirement account or chosen a company that reinvests profits instead of paying dividends, his outcome could have been far better.
This applies to real estate too. Take rental properties. A landlord earns $1,000 a month in rent. Sounds like steady income, right? But after taxes on rental income, plus expenses like maintenance and insurance, that $1,000 can quickly shrink to $600 or $700. Only by planning ahead, through deductions, depreciation, or tax-friendly structures, can rental property truly become profitable. And don't forget side hustles and small businesses. Every dollar you earn freelancing or selling online can be taxed as income. But many beginners forget that they can also deduct expenses, like a laptop, internet costs, or even a portion of their home office. Failing to track these deductions is like handing the government money it never asked for. Do you see the theme here? Taxes aren't about getting rich quick. They're about keeping the wealth you've already built. And the people who win at this game aren't the ones chasing loopholes. They're the ones who pay attention and plan ahead. In fact, wealthy families often talk less about how to earn more money and more about how to structure it so taxes don't eat away their future. And the good news? You don't need millions to use the same principles. You just need consistency, patience, and awareness. So, as you invest, always ask yourself, what's my return after taxes? Because that's the number that truly matters. In next chapter, we'll talk about the final shield in wealth building, protecting what you've built. Because money that isn't protected can vanish faster than it was earned. Building wealth is only half the battle. The other half is protecting it.
Because no matter how smart you are, life can throw unexpected challenges, medical emergencies, accidents, or even legal issues that can wipe out years of effort if you're unprepared. Let's start with insurance, the simplest yet most powerful tool for protection. There are many types, but the most important ones for beginners are health, life, disability, and property insurance. Here's a scenario. Emma is 32 and healthy. She thinks, I don't need health insurance. I hardly ever get sick. Then she breaks her leg skiing. The medical bills add up to $20,000. Because she didn't have insurance, that unexpected event drained her savings she had been carefully investing for years. Next, life and disability insurance. These aren't just for the elderly or the very wealthy. Imagine Alex, the sole breadwinner of his family. If he becomes unable to work due to illness or injury, without disability insurance, his family's lifestyle and financial plan collapse. Life insurance serves a similar purpose, ensuring your loved ones are taken care of if something happens to you. Property insurance protects your home, car, and valuable assets. Liability insurance protects you if someone sues you for damages or injuries. Many beginners overlook liability until a guest trips at their house or a car accident occurs. Suddenly, a legal issue can drain years of wealth. Another critical layer of protection is estate planning. Think wills, trusts, and beneficiary designations. Without them, your assets might be distributed in ways you didn't intend or get tied up in long, expensive legal battles. For example, Lisa built a strong portfolio of investments and rental properties. She never created a will. When she passed unexpectedly, her family had to go through a lengthy court process to figure out ownership. By the time it was resolved, a significant portion of the estate had been eaten by legal fees and taxes. Protection also comes from smart investment diversification. Imagine all your money is in a single stock and that company collapses. You lose almost everything overnight. But if your money is spread across different stocks, bonds, and real estate, one failure doesn't destroy your financial plan. And remember your emergency fund. It's not just for daily emergencies. It's a buffer that protects your wealth during market downturns or unexpected expenses. Here's the key takeaway. Insurance, legal planning, diversification, and an emergency fund aren't optional extras. They are the foundation that keeps your wealth safe, allowing all the effort you put into earning, saving, and investing to actually matter. In the next chapter, we'll tie everything together with actionable steps you can take today, so your financial journey moves from knowledge to real results. We've journeyed through the foundations of wealth: earning, saving, investing, protecting, and understanding the psychology behind it all. Now it's time to put the pieces together into a simple, actionable plan you can follow starting today. Step 1. Secure your foundation. This means creating an emergency fund, 3 to 6 months of expenses set aside in a safe, accessible account. Think of it as your financial shield. Before you build the castle, you need walls strong enough to keep you safe. Step 2. Manage your cash flow. Know exactly what money is coming in and what money is going out each month. If you don't track it, you can't control it. This is where most people either win or lose with money. Step 3. Eliminate high-interest debt, especially credit card debt. Think of debt as a hole in the bottom of your bucket. No matter how much you pour in, it leaks out until you fix it. Getting rid of bad debt is the fastest way to free up cash flow for investing. Step 4. Start investing as early as possible. Remember the power of compounding. It's not about how much you start with, it's about how long you give your money to grow. Even $100 a month consistently invested can become tens of thousands over time. Step 5. Keep your investments simple. Instead of chasing hot stocks or complicated products, focus on broad diversified investments like mutual funds, retirement accounts, or even simple savings plans tied to your goals. Simplicity keeps you consistent, and consistency builds wealth. Step 6. Build multiple streams of income.
Relying on one job, one paycheck, or one business is risky. The modern world rewards those who create backup plans. Side hustles, freelance work, digital products, or small investments in real estate can all become second or third streams of income over time. Step 7. Protect your wealth. This means having insurance to guard against the unexpected, estate planning to ensure your assets pass smoothly, and diversification to spread out risk. Step 8. Commit to lifelong learning. The financial world changes constantly. New tools, new risks, and new opportunities. But one thing never changes. The people who stay curious and keep learning are the ones who stay ahead. Let's paint a picture. Jamila, age 25, earns $40,000 a year. She starts by saving 3 months of expenses as an emergency fund. She then pays off her credit card debt using the snowball method. Once free, she invests $200 a month into a simple retirement account. She also starts a side hustle selling digital art, which brings in an extra $300 a month. Over time, she adds insurance, builds her investments to $500 a month, and watches compounding do the heavy lifting. Now fast forward to age 45. Without any lottery wins or sudden wealth, Sarah has built a net worth well into the 6 figures. All because she followed the steps: foundation, debt elimination, consistent investing, multiple incomes, and protection. And here's the most important reminder. Wealth isn't built in giant leaps. It's built in small, repeated steps. It's not about luck or being born rich. It's about discipline, patience, and making choices that your future self will thank you for. If you take anything away from this series, let it be this: money is a tool. Use it wisely and it will serve you. Neglect it and it will control you. So, start today wherever you are with whatever you have, because the best time to build wealth was yesterday. The second best time is right now. This concludes our journey through investing for beginners, how normal people grow wealth. May this not just be knowledge you heard, but actions you take and habits you build for a lifetime.
Congratulations! You've made it to the final chapter of this Investing for Beginners Masterclass, powered by NexAura-FinanceHub. By now, you've taken in a wealth of knowledge about how investing works, why it's not just for the rich, and how everyday people like you can build wealth step by step. We've explored the power of compounding, how to evaluate risks, and how to think long-term instead of chasing quick wins. You've seen how people from all walks of life, teachers, freelancers, parents, young professionals, have turned small, consistent investments into life-changing wealth over time. And most importantly, you now understand that investing isn't a mysterious game for Wall Street. It's a habit, a mindset, and a tool for anyone willing to learn. But here's something important to realize. Investing is only one side of the wealth-building equation. The other side? It's your ability to create and manage cash flow. Think about it. If your monthly income is already stretched thin, if bills and expenses are eating up every dollar, then what's left to invest? This is the challenge many beginners face. They understand the value of investing, but they struggle to find the extra money to get started consistently. That's why, in our next masterclass, we're going to dive deep into something just as powerful as investing: creating multiple streams of income and managing daily cash flow effectively. We'll talk about practical, real-world strategies for improving your personal and business cash flow. We'll explore how you can take the skills you already have and turn them into side hustles, whether that's freelancing, creating digital products, or even tapping into the growing gig economy. And here's the exciting part. You'll see exactly how someone can go from earning an extra $200 a month to building a sustainable side income that not only pays bills, but also fuels their investing journey. Imagine this: a teacher who tutors online after school and uses that income to invest consistently every month. A graphic designer who turns weekend freelance projects into enough cash flow to pay down debt faster. Or a student who starts a small digital product store, generating passive income that grows over time. These aren't just abstract ideas. They're real scenarios happening every day.
Masterclass 2. Cash flow and side hustles, creating multiple streams of income, will show you step by step how to make that possible for yourself. You'll learn not only how to create income, but also how to scale it, manage it, and channel it into investments that build your long-term wealth. So as we close this first chapter of your journey, let me leave you with this. Investing is how you grow wealth, but cash flow is how you create the fuel to keep that engine running. If you've gained value from this masterclass, make sure to subscribe, follow, and stay tuned, because Masterclass 2 is where things get even more exciting. Together, we'll unlock not just the secrets of investing, but the practical tools for building a lifestyle of financial freedom. This is NexAura-FinanceHub, where we don't just teach money, we teach freedom. Thank you for being part of Masterclass 1, and I'll see you in the next one. Welcome back, and congratulations again for making it through this Investing for Beginners Masterclass powered by NexAura-FinanceHub. Before we wrap up completely, we want to give you something special, an exclusive bonus lecture designed to sharpen your financial instincts even further. The title of this bonus is simple but powerful: Investments to Avoid If You Want to Succeed. You see, while most masterclasses talk about what you should do to build wealth, very few explain what you should not do. The traps, the scams, and the bad decisions that can silently destroy years of progress. That's exactly what this lecture covers. It's a session designed for both beginners who want to start safe and smart, and for intermediates who may already be investing but need to tighten their decision-making framework. We'll walk through the flashy but dangerous investments that lure beginners in. Things like get-rich-quick schemes, hype-driven assets, or high-fee products that eat away at your returns without you realizing it. You'll learn why guaranteed double-your-money offers are never what they seem, and how to spot the red flags before you lose a dollar. But it doesn't stop there. We'll also tackle more advanced traps that even experienced investors fall into. Over-leveraging with risky loans, chasing trendy markets without understanding them, or getting locked into complex investments with hidden costs. To bring it home, we'll share real-life stories of people who lost big and how they could have avoided it with the right mindset and tools. By the end of this lecture, you'll be armed not just with the knowledge of how to invest, but also the wisdom of what not to invest in. Think of it as the financial armor that protects everything you've learned in this masterclass. This bonus lecture is available now under the title Investments to Avoid If You Want to Succeed. And the best part? It's crafted for both beginners and intermediates, so no matter where you are on your journey, you'll walk away with lessons you can apply immediately. So, once you finish this masterclass, make sure to check it out,
Because in the world of investing, avoiding mistakes is just as important as making the right moves. This is NexAura Finance Hub, helping you grow smarter, safer, and stronger in your journey to wealth.